There is a federal law that took effect on January 1, 2024, requiring most small businesses in the United States to file a report with the federal government or face fines of up to $591 per day, a $10,000 penalty, and the possibility of 2 years in prison. Most business owners have never heard of it. A significant number of those who have heard of it still have not filed. And then the courts got involved, which made everything more confusing. Here is what you need to know. The Corporate Transparency Act was passed by Congress in 2021 and took effect January 1, 2024. The law created a new reporting requirement administered by FinCEN, the Financial Crimes Enforcement Network, a bureau of the U.S. Treasury Department. The stated purpose of the law is to combat money laundering, tax fraud, and the use of shell companies to conceal illicit wealth. Congress was concerned that anonymous LLCs were being used to move criminal proceeds through the financial system with essentially no oversight. The requirement applies to what the law calls reporting companies, which includes most LLCs, corporations, and similar entities formed by filing with a state government. There are 23 categories of exemption, including publicly traded companies, banks, insurance companies, and large operating companies with more than 20 full-time employees, over $5 million in revenue, and a physical office in the U.S. The vast majority of single-member LLCs and small corporations do not qualify for any exemption. The report itself, called a Beneficial Ownership Information Report, or BOI report, requires disclosure of every individual who owns 25% or more of the company, or who exercises substantial control over it. For each beneficial owner, you must provide their full legal name, date of birth, residential address, and a copy of a government-issued ID such as a passport or driver's license. The filing is made directly on FinCEN's website and is free of charge. It takes most business owners roughly 20 minutes. The original deadlines were as follows. Businesses formed before January 1, 2024 had until January 1, 2025 to file. Businesses formed during 2024 had 90 days from their formation date. Businesses formed on or after January 1, 2025 have 30 days. If any information changes, a beneficial owner moves, changes their name, or their ownership stake changes, the company has 30 days to file an updated report. The penalties for willful non-compliance were $500 per day at inception, later adjusted to $591 per day to account for inflation. Then the courts intervened. In December 2024, a federal district court in Texas issued a nationwide injunction blocking enforcement of the CTA, finding that Congress had likely exceeded its constitutional authority. FinCEN immediately suspended enforcement. That injunction was temporarily stayed, reinstated, and then the Fifth Circuit Court of Appeals got involved. By early 2025, FinCEN had issued guidance stating that while litigation was ongoing, it would not enforce penalties against companies that missed deadlines during the injunction period. The situation remained legally unsettled through the first quarter of 2025. Here is the practical position as of 2025. The law itself has not been repealed. FinCEN has continued to accept voluntary filings. The DOJ and Treasury have indicated they view the law as constitutional and intend to enforce it once the courts resolve the question. The prudent course of action for any business that has not yet filed is to file voluntarily. The report takes 20 minutes. The information you submit is not publicly accessible. It is stored in a secure federal database available only to law enforcement with proper authorization. There are two common mistakes business owners make here. The first is assuming the exemptions apply to them when they do not. The large operating company exemption requires all three conditions to be met simultaneously: more than 20 full-time employees, more than $5 million in U.S. revenue, and a physical office in the U.S. A sole practitioner with $6 million in revenue but no employees does not qualify. The second mistake is assuming that because there is a court injunction, there is no obligation to file. The law still exists. The injunctions affected enforcement timing, not the underlying requirement. If you have multiple entities, a holding company and an operating LLC, for example, each entity must file separately. Each beneficial owner must be reported in each entity in which they hold a qualifying interest. Note also that a company manager or officer who exercises substantial control but owns less than 25% is still a reportable beneficial owner. The concept of substantial control includes senior officers, those who appoint or remove senior officers, and those who direct important decisions of the business. File the BOI report. Go to FinCEN.gov. Navigate to the BOI e-filing system and complete the report for every entity you own that does not clearly qualify for an exemption. If you have any doubt about whether an exemption applies, consult a business attorney. The $200 consultation fee is considerably less than $591 per day. Keep a copy of your filed report and confirmation number. If you have never heard of this law until today, you are in good company, but that is no longer an excuse. Filing the report is the easy part. Knowing which other quiet rules apply to your entity is where most owners get caught. If this was useful, our video on when you actually need a CPI and when TurboTax is fine helps you decide who should be watching for the rest. It is on this channel.